Sale is down over 3% in trade after reporting a weak set of numbers, now down close to 4%. Volumes miss estimates, realizations under pressure. The company's net debt also remains elevated.
Indian Hotels is up close to 5% after reporting a strong set of numbers in a seasonally weak second quarter. The management tells CNBC-TV18 the second half of FY25 will see strong growth and the best is yet to come.
ITI is up nearly 8% after the company's consortium emerges as the lowest bidder for a 3,000 crore rupee BharatNet project.
GE Shipping is down more than 5% after posting mixed set of numbers in the second quarter. Revenue up 10%, but profits fall by around 4.5% on year-to-year basis. The management tells CNBC-TV18 that the easing Russia-Ukraine tensions should have a positive impact on shipping rates.
GMM Pfaudler down nearly 7% after reporting a weak set of numbers in the second quarter. The EBITDA comes in lower by 35%, whereas the margins fall from 15% to 11.5% year-on-year.
Hello and welcome to Chartbusters. I'm Nigel. With me is Mangalam. It's a Friday morning. The markets are more or less flattish, but plenty of movers in the broader market. So let's get straight to the first management on the show. RHI Magnesita, the company reported a rather weak set of numbers. Realizations were weak. Input costs as well spiked up. Mr. Parmod Sagar, who's the managing director and CEO of the company, joins us on the show. Hi, sir. Good morning, and thanks a lot for speaking to us here on CNBC TV18. Well, things are a little bit tough, but when the going gets tough, the tough gets going. So give us a couple of details. Volumes, they have recovered on a quarter-to-quarter basis. But for the year, what kind of volume growth are you looking at? Point number one. And point number two is, on the realizations aspect, it continues to remain under pressure. Have realizations bottomed out?
I think, Nigel, we're looking at pricing from two perspectives. One is input cost and the other is market condition. When we talk about input cost, the raw material pricing, particularly white fused alumina, brown fused alumina, or at broader sense, all alumina-based raw material pricing is going up. It is increasing rapidly. And also, the basic raw material is also going up to some extent. Freight still remain volatile and elevated. So we believe because of this, pricing should remain stabilized, but should increase at the same time because this is not a sustainable thing. We are expecting market to improve with planned new commissioning of plants, brownfield plants, which JSW, Tata, everybody is talking about, and it should happen in next 6 months' time or so in 2-3 places.
Got it. All right, sir. So volumes will pick up is what you're telling us. On the raw material side, there is still some challenges. Now, give us two details. Earlier when we spoke, you said that the blended margins should move up to around 14-15%. Do you stick to that guidance? Because in the past quarter, it was a little bit short of those levels. It was at around 12.5%. So do you maintain second half of the year, margins will move up, and for the year, you will be at 14-15%?
I always maintain it should be around 15%, and I still maintain that statement. And this year also, this quarter, it is 14.1. You can consider, okay, this is a one-time in between, but there was some provisions which we took with thinking of the performance, but the performance came better, so we released that. So in a way, I don't see it one time. It is part of the growth story, part of the actual EBITDA.
Okay, and what about revenues? They declined at the half-year mark for the year. Can you give some growth?
Yeah, that's what I'm saying. Because of the pricing got down, the revenue is in terms of numbers is looking like it is depressed or came down. But actually, if you see volume, 4.8% growth in volume in this quarter. So as I said, raw material prices are going up. Now we will have a correction in pricing. We'll get price increases and revenue will go up in next quarter and to next quarter.
Okay, but we'll talk more about your operational performance. But as I always ask you, the Dalmia Group has a big stake in the company. Have you heard about them? Do they intend to sell? Things are not yet improving, so they also must be wondering what to do. What's your view? Will they potentially sell before the end of this fiscal? And if yes, is the parent entity interested in buying their stake?
I don't see any in near future. I never talked to Mr. Dalmia. So I think they still believe in the growth of the company, but he's the right person to answer this question.
Okay, all right. No, please talk to him if you have to. But in case you're talking about the deal, then we would like to know what's the update out there. The acquired assets, since we're talking about Dalmia, you were saying that the Dalmia asset will start growing now, maybe by mid-teens. Has that happened? Because it's not grown too much, I think so. Point number one. Point number two is the margins of Dalmia asset were relatively lower. Though from the time you have taken it over, you had improved it, I think, to low teens. What is the guidance on both these two parameters? Growth at Dalmia and margin band.
One is now we are looking at the consolidated number. We are not looking at, Dalmia or High Tech or ORL. We are looking at consolidated number. We talk about 14-15% growth in Dalmia plants. At that point of time, we were looking at robust export, etc., which is not happening because of the geopolitical situation globally. So it has impacted us. But at the same time, we grew exponentially in our cement business. We are growing in iron making business through these Dalmia plants, and we are still very positive that we will deliver in medium term whatever we are guiding to the market. When it comes to profitability, it was less than 7% EBITDA when we took, and we are at 11.4 or 11.5%. And our ambition is to still maintain 12 to 13%. And I'm very sure in coming days we will be able to deliver that as well.
On that optimistic note, we'll thank you, Mr. Sagar, for joining in. So we're going to hold you blended margins of 14 to 15%. Volume growth will come about as newly commissioned plants come on stream. And also from the Dalmia Group, you haven't heard about the intention to sell. You're focused on improving the asset. Thanks a lot for joining in.
Thank you very much.
On that note, we'll slip into a snappy break. Imami is waiting for us on the other side.
Well, let's get in the second management on our show today on Chartbusters. We have the management of Imami joining in, which reported a slightly stable-ish set of numbers in an otherwise weak consumer sentiment as well, and as a result of which the stock too unperturbed, mildly in the red, in pretty much the similar way as the market has been as well. 1.7% in terms of volume growth, revenue growth at 3% as well. Mr. Bansali, who's the CFO of the company, joins in. Thanks a lot, Mr. Bansali, for joining in. The first obvious question, target revenue and volume growth for the second half, given the first half saw 6% revenue growth and domestic volumes which grew by just about 5.5%.
Yeah, we expect a high single-digit kind of a growth on an overall basis. So we still aspire to be double-digit growth in the second half. We believe that the second half would be good in terms of the season, the winter and the summer both. And we are poised for growth. We have taken so many initiatives, and we are confident of delivering a high single-digit growth.
High single-digit growth on the revenue or volume?
On the revenue. So
okay, and
volume growth has been lesser by around 2%. So the price rise is just 1.5 to 2% only for the year.
All right, so high single-digit revenue growth, mid to high single-digit sort of volume growth is what we're expecting in the second half of this year. And what about margins? Because, in the second quarter, while the revenues grew just about 3%, your margins moved to about 28%. For the full year, what is your guidance?
So the material costs have been very benign. Even the advertisement cost has been lesser in the first half. We observed that the markets were not reacting to the initiatives which have been taken, and so we conserved the resources. And the margins has improved. On an overall basis also, we expect margins to improve a bit, and we will be investing behind the brands also. Despite this, we expect some margin expansion.
Could you give us a band and also ad spends? First half was close to around 18.3%. So what is the ad spend band that you're looking at as a proportion of sales? And if you could give us a number on the margins.
On an annual basis, we would remain at the same level as we were at the last year. So it will be around 18% on an annualized basis also. So the second half, as a higher volume of numbers, and also the advertisement would be higher in terms of the absolute, but in actuals also, the percentage would remain almost the same as we are in the last year. And EBITDA margin expansion has happened in the first half. And also that is because of the gross margin as well as the other expenses. That trajectory would continue. We expect around, compared to the same period previous year for the full year, we expect a little EBITDA margin expansion. But it would not reduce.
Okay, we assume about 50 to 100 basis points in terms of an expansion out here. Cash King, it's been underperforming from the time you've acquired it, even now. So what's the revival plan for Cash King? And if you could also give us a sense on the target growth that you have in Man Company, because after increasing your stake, the last quarter was a bit of a washout because of this transition. So on Cash King and Man Company, what are your targets?
So for the Cash King, there has been, because there's been a discretionary kind of a spend from the consumer standpoint, there has been underperformance compared to our expectation. And but we believe, but the market shares are intact, and we believe that in the going forward, we would be able to demonstrate a good growth there. And we also robbed in BCG, the Boston Consulting Group, for advising us on the growth strategies for skincare and hair care brands, which includes Cash King as well.
All right.
We hope on the Man Company, as you asked, yes, that because of the transition and the change in the management, there has been impact on the performance for the quarter, and we hope to get stabilized in this first full financial year, and expect moderate growth and with EBITDA positive outlook.
What is moderate growth on an annual basis? What does the revenue of Man Company look like this year?
A moderate growth could be around 5 to 10% for the full year, and EBITDA positive is EBITDA positive.
Right. Obviously, EBITDA positive is EBITDA positive. Final question then. Everyone's been talking about weakness in consumer sentiment in the second quarter, but you are in the eastern part of the country where the festive season comes in a little earlier. Have you seen any signs of revival, or do you think the second half could be only marginally better than the first half?
But our presence is across the country, so it's not just the eastern part. And but we have seen that there has been a festive, and it is also few of the category centric, where you find that the affluent people in the premium ranges, and so there has been a good spurt. In few of the channels, there has been a good spurt, but in few GT channels, or for that matter, for other LUPs or all, so there is still the spurt has to come. So there is a mixed feeling as yet, but we believe that the more has to be done by the season. The winter is expected to set in, and we expect the winter to be the same stronger winter as the summer had been, and this will have a good impact on the financial performance for the consumer businesses.
All right, we take that point. And for you, over 50% of your revenue is also coming from the winter products. So that would aid your growth if the winter is good. Thanks a lot, Mr. Bansali, for joining in. High single-digit revenue growth with margin seeing a 50 to 100 basis points improvement over last year. And mid to high single-digit volume growth is what the company is poised for in the second half of this year, even as consumer sentiment is mixed. Take a short break, come back on the other hand. On the other side, rather, we have the management of IMFA joining in to discuss their last quarter's performance.
Welcome back. Markets are volatile, but one stock that's on fire this morning is IMFA. The stock is now up close to 8.5%. The past quarter's numbers are good. The outlook appears fairly stable, and they also declared a 10 rupee dividend. Mr. Subrakant Panda, the managing director of the company, joins us on the show. Hi, Mr. Panda. Good morning, and always good to see you in. Well, your shareholders will want to understand what's the way ahead from here on. So could you tell us, how is pricing shaping up? What was it in the past quarter? What is it currently? And this run rate of around 160, 170 crores per quarter will only get better from here?
Good morning, Nigel. Always a pleasure to catch up with you as well. So we are obviously very pleased with the numbers because, all that we have worked very hard over the years to build up the fully integrated business model and the conservative approach in terms of now being debt-free is paying off. In terms of the Q2 numbers for FY25, broadly speaking, prices were the same as Q1, maybe a little bit off, and costs were roughly the same, and volumes were significantly higher, which is why you have seen the numbers improve a little bit over Q1 and substantially over the corresponding quarter of last year. Going ahead, I had in an earlier interaction mentioned that we would expect H2 to be better. That was basis the assumption that the stimulus measures in China will kick in a lot earlier than they were announced. That hasn't happened, or it happened later than what I anticipated is a better way to put it. So what you're seeing now is China prices around the 90-cent mark, but given our blend of spot and long-term contracts, we are looking at an average realization during the ongoing Q3, roughly in the mid 90s. And that coupled with the rupee depreciation, which is now at 84.35 or so, is going to enable us to, by and large, maintain the same margins that you're seeing in the current quarter. So pricing forecast, prices have come off a little bit. So what you will see in Q3 is the top line numbers cool off a little bit, but costs are also moderating, especially metallurgical coke. And therefore, by and large, we should be able to maintain these margins. Specifically, the guidance, although we don't really talk about it in that manner, but EBITDA for each of the remaining 2 quarters, I would say 150 with upside potential.
No, but you said that the last time as well. You did 160, you did 170. So it's not fair to talk about 150 crores then. Will it be better? Will it at least be 160, 170 crores at current reckoning, current prices, current input cost?
So we are expecting possibly a slight cool off in Q3, but it all remains to be seen. Obviously, the rupee depreciation is very much in our favor. And now with the stimulus measures in place in China and the uptick in PMI that you have seen in October, I would expect ferrochrome prices to start picking up. But at the moment, ferrochrome prices in China are about 90 cents, which is not, which works well for us because we are extremely competitive. But it doesn't work for a whole lot of peers, and which is why we're expecting some degree of improvement. And you're seeing that in India as well, with high chrome ore prices. Ferrochrome production in amongst non-integrated producers is getting choked off, and all of that combined is going to support prices.
Right, Mr. Panda. Every time we speak to you, we have to ask about the Utkal C compensation. Of the 220 crore which was pending, how much have you received, and by when do you receive the rest?
So all of that has been received. So in as much as land is concerned, so to break it up, the initial, which was several years ago, couple of years ago, 20 odd crores towards various fixed expenses and all of that has come in. The 352 odd for land has come in, although that is disputed by the new LOT, and that is a matter which is pending before the tribunal. But as I have said in the past, we are very confident about where we stand on that, and in fact we believe that we are entitled to a little bit more. But be that as it may, that entire amount has been received. And a little while as in a week or 10 days ago, the mines infrastructure compensation has been finalized at 8.5. That is not something that we are satisfied with, because we were expecting about 20 odd crores. But that's something that we will again have to take up. But so pretty much all of the money that we are entitled to has come in to the system.
So 350 plus 20 plus 8.5 has come in.
The 8.5 is yet to come in, I believe, but the rest has come in.
All right. The bigger trigger for the company in the next 3 years, the market believes that the EBITDA number will go up substantially because your capacity is going to go up by 40 to 50%. What is the update in terms of the permissions that have come in, and in which quarter do we see the expanded capacity come on stream? 2026, early 2026, would that be a fair estimate?
So mid 2026 is the assumption at this point in time. So we are currently in the process of building the boundary wall and taking possession of the land, and we expect to have groundbreaking in January, and roughly 18 months construction. So that takes us to mid 2026. Although once we kick off construction, we will certainly look to see how we can compress the timeline and advance it maybe by a month or two. So mid 2026 for the first furnace, and the second one following shortly thereafter. So that will add about 100,000 tons of capacity, which is the 40 to 50% that you are mentioning. But we are also, as you are aware, working on a ethanol project. And there too, we expect to start construction in December or maybe spilling over into January. And that will, that's something that will add about 300 odd crores to the top line. And that is something that we expect to commission by the end of 2025.
Okay, by the 2025, all right. And that 300 crores will give you margins of around 20%, right?
Well, it's again a factor of what the input costs are for grain-based ethanol, etc. But broadly, I would say in the 15 to 18% range is what we are expecting at this point in time.
Always good speaking to you, Mr. Panda. Second half of the year, you could do 150 crores at least of EBITDA. That would take your total EBITDA for the year to around 650 crores. Thanks a lot for joining in. Well, that's the management of Info. Stock at the high point of the day as we speak, but we have run out of time on Chartbusters. Stay with us. Trading Hour comes up next.